I would like to welcome everyone to our May 2022 market update, as it's been over a year since our last market update. In the past 12 months, the markets have been very cooperative, and much of the anxiety due to the initial reaction of COVID-19 in 2020 had wore off. However, recent volatility in the last few months prompted us to provide our perspective of what we're looking towards in the future. And as many have noted, markets have been in a bit of a rough patch, seemingly since about the beginning of the year. And we're confident that there are some scenarios that money will flow again into the stock market. And we feel that's directly tied to interest rates and, by connection, inflation. So let's first talk about that. What has moved the market in our perspective with regards to interest rates and inflation. We'll notice here in our first illustration on a chart of the consumer price index, which is the general measure of inflation, the CPI. So here, just a little background of what the CPI is. It's a basket of goods and services. You see many of those kind of listed there up at the top. And no doubt you've probably felt some of the squeeze in some of those: food, energy, home prices, etc. But in general, what moves pricing economics is connected to demand and supply. So when there's high demand for certain items or a low supply of them, this increases prices. And when you have both of those scenarios, we see a swift rise in prices, as we've seen the very end of this chart going towards April 2022, that very recent spike that we see. But over the last 20 years, it's hovered in that range between 0 and 5%. But the beginning of this year has prompted most of the anxieties for the stock market: the swift rise of inflation and consumer prices. And we're going to talk about this in a moment, but we feel that this is very much event-driven. So keeping those two terminologies in mind of supply and demand, we're going to talk about some events that may drive the opposite effect of demand and supply, which and thus would turn lower inflation and potentially curb the increase of interest rates. Now, demand could drop if consumers and businesses spend less. Now, there's certainly some reasons for that. Not all of them are good or what we are hoping to achieve. A drop in consumer spending could happen if, for example, unemployment rises. Currently, unemployment is lowering, and that's not necessarily the outcome of a weak economy. It's what we would like to bring prices back in check. And so that's probably not the scenario that we're hoping for, but that could have effect on demand. Also, consumer sentiment, how we feel about our general wealth, financial state, the outlook of the economy, etc. Consumer sentiment. This could be affected because of the plunging stock market, higher gas prices, etc. Job outlooks in the future. All of this could have a negative effect on demand, and thus consumers spend less and then driving prices down. Also, supply. With regards to supply could increase as a result of loosening of the supply chain constraints. The last couple of years, we've seen that in various sectors, recent news with baby formula. So it's still affecting different parts of the market, supply chain. Over the last year or two, it's affected homes, building materials, which rose, which resulted in the rise in home prices, one of the many issues with that. So loosening of supply chain constraints due to perhaps COVID lockdowns in China and other areas, increasing in distribution centers and other technologies to provide this too could increase, allowing then prices to decline. Of course, increasing production is another obvious way to increase the supply. We see some pressure with that due to war-torn areas with regards to energy, oil and gas, as well as food as well. So boosting things and those types of production activities, food, this could be abated, an event again, with ending of the Russian war in Ukraine, increased technologies. And of course, in the last couple of years, we've had higher than normal disasters that have affected growing seasons. So again, a calmer disaster for growing seasons, this could increase the supply chain. Thus as well, lowering down prices and by its connection, inflation. So a couple events that are not improbable that could, in the short term, we could see inflation starting to pull back dramatically. But we all want to know, well, how low are the markets now and how low could they go? Well, looking at here, just a quick snapshot of the market going back a few years for the S&P 500. And I've tagged that here. I know it's a busy chart, but towards the end is where the S&P and its recent declines are. And you got to go back to March of 2021, and that's roughly where markets have retraced themselves from their high of around 4,800. So from its high, we've seen a swift contraction, but overall, looking at the past 3 years, we certainly see that trend. Could we see a low of the pandemic? We see that big trough there in the beginning part of 2020 as the pandemic was raging on. We saw very, very swift declines in the markets and then its subsequent rebound. Could we see further downside? It is possible. But again, looking at some of those events, it's not one that we see worsening supply chain constraints, worsening COVID lockdowns, and we don't expect that the war escalates to further supply chain worries. So looking at kind of the current bear market, which in our opinion started sometime last fall, and as mentioned, directly connected with inflation, rising interest rates, and the supply chain, and of course, recently in the last couple of months, the war. Question is are we near the bottom? Which we'd all like to know, but based on some statistics here, look at our next illustration here, some of the low points, some of the potential triggers that we see here at the top are areas where things were oversold and at the bottom overbought. So what that means is we see off the very right there, that's our recent decline. And are we looking at the bottom there, that green line that cuts across, which tends to be an inflection point where investors feel that, hey, enough has eroded out of the market where I see some real value in stocks. And based on this particular chart, we could be very near or at that point where investors feel that the market is oversold. It's been, the market was too knee-jerk in its reaction. So we could be nearing that area there. It's very close, that bottom right circle there, very close to that green line, that we could see an attitude change, that the market was overblown, that it was oversold, and it's now time to enter back into the market. But as we've mentioned, and even into our last market update of last year, what we had been looking forward to during that time, as during the pandemic, much of the growth stocks were grossly overbought to a point of bubbles in certain areas, and we had encouraged the safer investments, higher dividend stocks that were more stable with a coming potential downturn. So what have we seen since that? Well, we look here at our next chart. The very growth-heavy NASDAQ has diverged from much of the other indexes, the Dow and the S&P 500, to a large degree. The NASDAQ being comprised of mostly growth stocks anymore, as it compares to the Dow, the S&P, which still is very heavily weighted to value or higher dividend bellwether type stocks. So we see here that bubble, so to speak, in technology and growth related stocks have bust a little bit, and we see some repricing in the markets. So again, this has a general impact on all the indexes and the markets in general, but how it applies to you as we've shifted away from the growth stocks in the last year, 18 months, we found that the portfolios are performing better than the general markets today because of shoring up the higher dividend, the value stocks in the portfolio. So we continue to monitor the situation, but again, wanted to provide this update for those who are curious of our perspective going forward in the markets.